As investors, condos are very tricky. Even as homeowners, condos are a whole nother animal. And so the condition condos can only be lent on if they're solid in their association. A lot of associations recently across the country have been having issues of financial stability because of the insurance going up, because of Mother Nature. Um, and one property in Florida caved in, went into a sinkhole. And so that started the whole thing with Fannie Mae and Freddie Mac tightening up on condo rules. Then here in California, there was an incident in Berkeley where there were 30 or 40 people on a balcony and the balcony collapsed. So the electeds came up with a new law a few years ago that said all 2 stories or more with any exterior extension, which is a walkway, a balcony, anything that protrudes from a building, has to be inspected and any problems cured. So a lot of condo communities have your unit has a balcony. And a lot of condo communities are, 100, 200, 500, 1,000 units. And so all of a sudden, they had like a year to get an inspection done and get all the problems solved, which is a lot to do in one year. So a lot of condo communities did not meet the deadline. And so Fannie and Freddie said, hey, you have to finish those repairs before you can finance any units in this building. So that was a huge problem. Some condo communities in the South Bay, in LA, were delisted off of Fannie Mae. So unless you provide all kinds of proof to get back on the list, there were no Fannie Mae loans done in those buildings. And additionally, you could do what's called a non-warrantable condo. So when your condo is in good shape, Fannie Mae warranties that you're good to go. Non-warrantable means Fannie and Freddie do not want to lend there because there's some kind of issue. So the different things that that Fannie, Freddie, FHA, VA, whenever you're trying to get a condo community approved for financing, they look at how many people live there versus our renters, how much are the reserves. So in other words, not just you're not just collecting HOA dues to pay the bills, but you're also setting aside reserves. Is there any one person who owns more than 10% of the building? Does the master insurance cover certain liabilities like employee theft, all kinds of coverage, just like your homeowners, but for the community, liability, trip and fall, all of that. And is it enough coverage to rebuild the complex? That's a big number, right? Let's see what else. Oh, what kind of lawsuits there are and what kind of condition the units are in. So all of that is looked at to get a building approved. With FHA and VA, once you're approved, you only have to renew your approval every couple of years. With Fannie Freddie, you don't have to do anything, but if they find out there's a problem, then you have a problem. So there's 2 ways that lenders have to discover if the condo community is in good shape or if there's a problem. One is a limited review, which is just a few questions, and one is a full review. Okay, so a limited review is just a questionnaire and you show the master insurance policy. The full review is they want to see the CC&Rs, the bylaws, the articles of incorporation, the reserve study. Do you have enough money for your reserves and upcoming repairs that are coming up? By the way, a lot of condos in the South Bay were built in the 70s and 80s. So guess what? A lot of stuff is, if it wasn't maintained, is going, is falling apart, needs to be replaced. So they're looking at the financials. Do you have enough for that? They want to see the current budget. They want to see the minutes, the 12 months minutes. So they are taking a deep, deep dive into the condo's, health, both financially and physically. So the big announcement, and so that's a big difference between limited review and full review. Completely different world of, and what I have been pushing for is condo communities for an online, access to documentation on average is costing $500 to get those documents. So let's just say you're a home buyer, you go out, you like a condo community, you pay for all these documents, which I think the seller should have to pay, not the buyer, but you get all these documents. Turns out the condo is not viable, or you don't like the what you found out in those documents. So then you stop buying that one and you start buying another condo somewhere else. You pay another $500. I mean, it's ridiculous. So hopefully we can, through policy at the state level, get a limit on what these condo communities can charge, because they're just uploading documents into a portal. We draw them down, or actually they send us a link. They fill in the condo questionnaire, and that's costing $500 to $600. The cheapest I've seen is $350. So it's really expensive. And, the big deal is that this limited review thing where you just show the master insurance policy and answer a few questions, that is being eliminated, stopped, kaput, gone August 3rd. So here we are, May 1st. Your application date has to be before August 3rd, or we have to do the full-blown review of the condo complex. Well, I think in any industry, we know the more information and data you get, the more you can go, oh, and find a problem, right? Okay, so here's a sample. You can see, this is just one of the lenders I use. Limited review form. So the legal name, city and state. You pick if you have any of these items. So basically, they don't like short-term, like condo hotels. I don't know if you guys know what that is, but it's like a condo. There's some in Hermosa Beach. It's a condo where you own the condo, but you're only allowed to be there so many days a year. You're only allowed to rent it out so many days a year. So it's a little weird. But so how they, you have to answer, are there short-term rentals? What's the minimum stay? Because a lot of condos have someone who actually manages the rental of your unit, right? Kind of like a timeshare. So there's a lot of questions here about whether it's kind of one of those things. Okay, so then how many units are in the project? How many are sold and closed? Usually 100%. Total number of units owned by the developer. Usually it's 0 when it's an older building. Largest number of units owned by a single entity. The max is 10%. You go over 10%, you're done. Are there units fee simple or leasehold? Fee simple means you own the land. Leasehold means you're on leased land. So like in the desert, we have a lot of leased land. Are all units, common areas, and amenities complete? Usually that's yes. Date the association. So all of these are easy questions when the condo is not new. It's been going for a while. Is the project subject to a recreational or land lease? So that can be a deal killer. Recreational, think golf, right? Are the units subject to recurring transfer fees from the development? Usually not a developer, not usually anymore. Do they have a mandatory club membership? That's a deal killer. Is the association subject to any lawsuits pre-litigation? So if this is yes, we have to show what the lawsuit's about. If it's a trip and fall, no big deal. If it's anything minor, no big deal. You just show what it is, and then the insurance company or the attorney's office has to say that the insurance of the HOA covers any outcome of that lawsuit. Do you have commercial space? You're only allowed to have 15% commercial. Has the HOA or developer retained any rights? So see, these are all to do about who really owns the complex. It's not, and then here they're asking about deferred maintenance. That's it. This and the insurance. And we all know what to look for as far as as lenders, we know what to look for as far as an answer that could be a red flag for a problem. So that is the limited review. I don't have the full review form out for you. I couldn't find one, but it's like 2 pages, 3 pages long, and it's more about the documentation. So all that to say, August 1st, no more limited reviews. That's number one. How I get around it is I work with lenders who have already gotten the package for a certain complex and they've approved it and they have their own internal review and approval list. So that's how we get around that massive amount of paperwork. You do it once and then you're done for anybody else who wants to buy in that complex. Secondly, even more scary for some condo communities is Fannie Mae and Freddie Mac are going to require a 15% reserve instead of the 10% that's required right now. So if you're a big complex, this could be a problem, right? If your reserve study says that you need, I don't know, 2 million in reserves, and now you've got to add another 15%, that means you've got to raise the dues on everybody to make sure that that's covered. And if you've been dipping into those reserves to do repairs because of the balcony law, you might be at 7%, which means you've got to get double the amount into your account. And you're going to do that over a certain period. But if you don't have those 15% reserves, you won't get a Fannie Mae loan. So these are big, big changes. There was one positive change is condo communities right now that are 4 units or less, there's no review required. Fannie Mae and Freddie Mac decided, or FHFA, who is the overseer of Fannie and Freddie, they've decided to stretch that to 10 units. So now if you have like small complexes up to 10 units, we don't need to do any review at all. So we just need the insurance. So that's very nice. So if your condo community is in trouble, you might want to pay attention to this because you've got to not only fix what you have a problem with, but meet the stricter requirements.